Good morning, everyone. Welcome to the Macro Snapshot. We are Friday, August the 22nd, 2025, recording this in the morning. Of course, everyone's now waiting for the for Jackson Hole. So let's have a quick look and see where the markets are before we just think what might be going on here. So let me just bring a couple of things down here. So what we've seen in equities over the last sort of period, first of all, for the volatility. Volatility has crept up a little bit, and that's normal as we're going into in an event. And actually, what's interesting, I just did a bit of research here, just on the kind of like the volatility service of ES compared yesterday. I did this actually yesterday afternoon. So expires today. That was the zero DTE from yesterday, and expires tomorrow is actually for today. And what you can see here is like this is at the money. Just down here, and this is the strike. So this is implied volatility here, and it's just interesting to see the difference of the Jackson Powell speech for the zero DTE for today compared to yesterday. And if you look at today's, which is the orange one, you can see that overall implied volatility has gone up quite a lot. Well, it's gone up sort of half a point or a point or so. But for a zero DTE, that's very, very important because obviously the expiry is very, very close. But what you can see is that overall the smile, but it's interesting, the tail risks here. So look at the tail risk. It's actually come down a little bit for today and also for tomorrow. And what that's saying, it's not so much that it's come down, it's simply saying that the tail risk is actually, there's more on both sides. So that's kind of interesting here to see that just what's going on here. You see that the possibilities of upside risks are also pretty high today. So that's quite interesting. And just while we're on this sort of volatility, let's just have a quick look at the option chart here. And you can see here for, again, just looking at the ES, you can see we're only at the 13% in terms of the implied vol percentile, and for the implied vol ranking for the last year at 33%. So the volatility has definitely gone up a little bit over the last couple of days, just to encompass today, but it's still at historically quite low levels. And then if we actually just look and see what the market's pricing in, we can look at, let's say, what a straddle costs. So let's just see what a straddle costs on the zero DTE here. So where are we? Where's our deltas? So, oops. Let's have a look here. Just bring that down. So we'll do that. Hold on, let me just do that again. So let's say this one here with a 50. That should. There we go. Okay, so you can see here a straddle is just loading up here. So a straddle is costing about 50 points. So about, yeah, there we go here. So about 51 points or about 200 ticks or so on the ES. Now that's not too much. That's less than 1% because you consider that at the money here is about 6,400. So 52 points is less than 1%. So not a huge amount of volatility priced in. And that could be because, I mean, I guess that's the saying that you know, the market is relatively comfortable with what it expects Powell to be saying. And maybe also just looking back at the charts here, just looking at, as I say, I'll just go onto the ES. Sorry, my computer seems to be a bit sticky this morning. We can see here that this is the ES. You see that the market has actually come off a little bit over the last few days, and there's various reasons for that. But basically going into Powell, the market's come off like 1% or so, and that's maybe just building in a little bit of a concession. If we look over at the NASDAQ, similar kind of situation as well. So the market has already priced in a slightly hawkish sort of a Powell. Now, what does that mean? What could Powell say today? And the market is you know, expecting something relatively hawkish. And we can see that if we look at, just start looking at, you know, just how the market's moved over the last few days and all this repricing, not only in equities, which we just saw, but if we now look at and see what the futures of the SOFR, the short-term interest rate futures are pricing. And so we can see for the September meeting coming up, only 17 basis points are priced in. So that's now just almost like a 2/3 of a chance of a cut. And if we go back a little bit, we can see, just wanted to sort of show a little bit going back 10 days. So this is going back 10 days. So 10 days is the blue number. And you can see here that all across the SOFR curve, so each point here on this sort of graphic represents a 3-month SOFR curve going to the future. So you can see the change in pricing hawkishly being repriced for the last 10 days. And you can see that, sort of anywhere from sort of the 9th, the 10th down here, you see towards the end of 2025 and the beginning of 2026, the market's repriced by about, depending on the exact contract, by about 8 to 10 basis points more sort of hawkishly. And you can also see that if you just look at the December pricing here on the tick chart. So this is December pricing in basis points. And you can see that if we go back to the 20th of August, which is just like a couple of days ago, we were almost down at about 58 basis points. So that's over 2 cuts priced in for the end of the year. And now we're back to 47. So essentially, we've moved, just sort of grinded our way upwards in terms of sort of hawkish repricing by about 10 basis points. And so that's also reflected in the September meeting. As I say, that was almost fully discounted. So that was about 20, 21, 22 basis points. We're now down to 17 basis points. But nonetheless, the market is still assigning a 67% chance. So let's say a two-thirds probability that Powell will endorse a cut in September. So what could Powell say? There's various scenarios here, and I'd say sort of the less market friendly in a certain sense would just be to be completely neutral and say he's data dependent, to say the Fed, is independent and they're data dependent. And that's all. And there's still, for example, there's still there's still inflation data to come. There's still GDP data to come, and there's still, of course, more labor and employment data to come before the meeting on the 17th of September. So Powell could simply just be completely neutral, say that September is a possibility for a cut, but it's maybe not going to be a cut. It will depend on the data, and completely ignore the political pressure he's receiving from the White House. And that would be taken as relatively hawkishly. On the other hand, he could say that yes, they're absolutely data dependent, but he, acknowledges the fact that there were those significant revisions at the August non-farm payrolls, the minus 258,000 jobs. So he could acknowledge labor weakness or potential weakening of the labor force. That would be slightly more accommodative, and the market would like that a little bit more. Or on the other hand, now going into what I think is less likely, but a possibility, would be for him to say that, inflation is a little bit sticky, but nonetheless, in terms of their mandates, he was particularly concerned about a weakening sort of employment situation, and that required their sort of close attention or something like that. That would probably be the more sort of dovish sort of expectation. But keep in mind, historically, I think I mentioned this yesterday, that the Fed historically does not like to go against market pricing. Now, there's two ways of looking at that. You could say that the market has already come to meet the Fed halfway, so the market is no longer sort of demanding a cut in September with 100% probability. It's got it back down here, as we see, to about 2/3 of a chance of a probability, 66% chance of a probability. And so maybe Powell's comfortable with that. He'd say, okay, more or less yes, but not exactly. And the thing is that there's still, quite a lot of time. We still have essentially a month before this next meeting. And maybe Powell's view is that, hey, if the data comes in, there's plenty of times to guide the market more hawkishly and say, hey, we're not going to be cutting, or actually to endorse the pricing almost back up to 100%. So it's going to be interesting to see which way Powell wants to play this. From a bigger perspective, will he mention all the political pressures? It is his last sort of keynote address at the Jackson Hole sort of symposium. So maybe it's a good opportunity to sort of talk about his legacy. And it could be, we know there's a lot of other central bankers there flanking him. There's a lot of, globally, other central bankers are literally on site in Jackson Hole. And he may want to take the opportunity to reiterate the fact that central bank independence, political independence, is fundamental. That's definitely a possibility. The market would probably take that as being a bit of a pushback to Trump, slightly hawkish in a certain sense, but I think completely expected. The other big thing, if you remember 5 years ago at Jackson Hole, if I remember, it was 5 years ago, maybe that seems a long time, maybe it was 4 years ago, but they introduced this flexible average inflation targeting, and this idea that was a very low inflation environment, you'll remember, and basically this idea that they didn't have to be preemptive and have 2% as an absolute cap on their sort of inflation goals, but really 2% will be sort of a longer term average, which implies, of course, that they could be under it for a certain period of time, but also above the 2% inflation at a certain period of time. And of course, that turned out to be very unfortunate timing, that new framework, because that's just when, coming out of COVID, as we all know, we got very sort of aggressive inflation, and it seems as though maybe that was part of the reason for the Fed not being proactive enough, was that they were allowing inflation to go a little bit higher. just to achieve some kind of longer term sort of average. So it's going to be interesting today whether he retires the whole concept, like the framework of flexible average inflation targeting. And I think if he retires that, that could be seen as a sort of a slightly sort of hawkish view that they need to get back to the basics and attack inflation. Now, and the other thing to keep in mind, of course, is that the latest summary of economic projections which we have still reflects two cuts. So the market is not being particularly divergent here from the Fed's viewpoint. The Fed itself, on average, for the members said that they want to cut twice. And of course, we know that there are a couple of dissenters and maybe even Stephen Mirren. There could be two or three people who absolutely will want to be cutting in September. So, a cut in September is not particularly sort of controversial. Anyway, let's see what sort of happens. And the other thing as well, just in terms, before we get potential market reactions, remember that next week we have NVIDIA earnings, we have GDP, and then the following week we have all the inflation numbers, and then we get the non-farm payroll. So the point is that in terms of Powell, there's still plenty of very important, maybe not so much in NVIDIA, of course, but there's still plenty of macro data, inflation data, numbers on the employment situation and the labor market, which Powell may just simply say today that he needs more information and he's going to remain independent and doesn't see any need to endorse the market pricing for a September cut. Now, in terms of what the market may want to do, I think it's pretty simple that, as I say, we've got a 66% chance of a cut priced in. I think that the markets which would most sort of suffer, so to speak, is probably going to be the short-term interest rate markets, like the STIR products, the SOFR. So if we just look here at the FedWatch tool, we can see that pretty much, you see what's expected here, 69% expected here, probability of a cut, but 30% still at this point not priced in. So it's not, remember that what we see on the Bloomberg number is simply, sort of a weighted average, so to speak, but there's still plenty of market participants who do not believe the Fed will actually cut at the September meeting. Now, let's say if we fast, and actually, but you can see how that's changed. So let's just go back to September here. And you can see how that's changed. If we just go back and compare that, you can see, as we looked at earlier on a different graphic, you can see that, let's say, for example, 1 week ago, that the chances of a cut were much higher, and they've come in quite a lot. And you can see, so that's kind of interesting. But if we go and then just look at the December pricing, you can see that the probability distribution here is much more evenly spread. And you can see that there's even sort of 4% of market participants who believe that there's not going to be any change at all. And then you see 1 cut, 2 cuts, and even 3 cuts. So quite a lot of, I don't want to say confusion, but just sort of differing views. And it's not at all monolithic that everyone is expecting a cut. So when we say a 66% chance of a cut, it also means that quite a lot of people don't expect a cut. So again, just looking at the markets here, we can see, let's just look at the short-term interest rates. We can see that, let's say something like, let's say, look at the 2-year yield. And the point I want to make here is that Powell is going to be out, right? He's leaving next May. And so in some shape or form, there will be cuts because presumably Trump's new Fed chair will be sort of more dovish, and the board itself and the FOMC committee members, the composition will probably be a little bit more dovish. So in some shape or form, we can assume that there will be relatively, significant cuts coming over that, let's call it in the next 12 months or so. And Trump, I doubt, would be doing all of this unless he was getting some kind of significant cuts, at least 75 basis points, 100, 125 basis points. That's really what his goal is, even 200 basis points. So the point I'm trying to make here is that even today, if Powell is a little, let's say, on the hawkish side and doesn't explicitly endorse a series of cuts starting in September, for sure the 2-year yield, or the yield on the 2-year, which we have here, will go up. But as you can see, it's already been priced in a little bit. We've gone up from 367. We can actually measure that. I'm just kind of curious. You see that, let's say, over the last 4 or 5 days, the yield's actually gone up about 13 basis points. So, you could argue that hawkishness has already been priced in. And then the point I'm trying to make is that the 2-year yield here, it covers 2 years. So it's not just about what happens in September or October or December of 2025. The 2 years literally, trying to encompass a little bit what's going on over the next 18 months to 2 years. And so the point being here that, we've had a little bit of a sort of a hawkish concession already built into the 2-year yield, which has risen here. And B, you have to say, how much more can this sort of go above, let's say about 3.9, 3.95% or so? Because at the end of the day, within the next 2 years, there will be cuts. So the point I'm trying to say here is that the 2-year, yes, for sure, that yield could go up today on a hawkish pal, but really I think where more pain will be felt, actually will be at the front end of the curve, by which I mean the extreme front end of the curve, by which I mean the short-term interest rates. So let's say something like you could look at, let's say, September 25, and you can see there, for example, that this is the price here. You see the price here has gone down a lot. Again, there has been a concession, and again we can look at that. And similar to the 2-year, you can see that there has been a concession of almost 15 basis points. So the point is that today you have to, for Powell to really move the markets, at least in terms of the short-term bonds, he has to be quite hawkish, because the markets have already done quite a lot of the heavy lifting for him over the last 5 or 6 days. But all that to say that if Powell is a little bit more hawkish, I think there'd be more pain for the very, very front end of the curve, the short-term interest rates. So this would be like the SOFR September 23 or December 25 or December 25. This could definitely go down another 4, 5, 6 basis points. But I personally think that Powell will not explicitly take off or remove the possibility of September cut. So as we just saw on the Bloomberg, they're saying, there's about 17 basis points of cuts. I think that could go down to about 12 and a half, which would be half a cut. So maybe we're talking about 5 basis points or so. I think the market would be reluctant to, as I said, to totally remove the possibility of a cut in September, because we're going to be data dependent. So I think we might go down to, let's say, a 50% chance of a cut, down from 66%. Obviously, if he's dovish, it's going to be the opposite kind of reaction. The front end will love it. The 2-year will like it a lot. In terms of the yield curve, what is kind of interesting is that the more hawkish Powell is, of course, that will initially cause the yields to go up, but ultimately the long end of the curve will probably like that. If we have a look here at the 30-year yield, you can see that actually that hasn't really gone up nearly as much as the other ones, let's be specific, as the short term over the last few days. It has gone up, but it's now just sort of calming down a little bit. And the idea here is that, the more sort of inflation fighting Powell is, the more aggressive, the more sort of hawkish, and the fact that he's really fully focused on inflation and doesn't even mind unemployment rate sort of going up a little bit, ultimately that's going to be a good medicine for inflation, which ultimately will benefit or be beneficial to the long end of the curve here. And we could get sort of, at the end of the day, a little bit here of sort of a flattening, basically, if Powell is a bit hawkish. I think really is going to be a flattener. And we can just look at the yield curve here. Let's look at the, let's say the 2s, 10s. You can see that actually has been flattening. Again, it's built in a bit of a concession. And if we look at something like the 2s, 30s, you can also see that it's been flattening. And just on this idea that maybe the front end yields need to go up a little bit more and the back end yields are liking the fact that we might get a Powell who's more focused on inflation and who actually, as I said, doesn't mind if the economy growth expectations go down a little bit, which ultimately would cause the yields on the long-term bonds to come in a little bit. So I think really that's what we're going to be seeing today. A hawkish Powell could cause sort of some flattening on the curve. Obviously, if he explicitly says that he's noted the weakness in employment, he's concerned about that. If he emphasizes the fact that that definitely is a very important part of the mandate, et cetera, we could get the opposite, and we could get, the front end yields coming down, which would imply less fight against inflation, exactly the opposite of the scenario I just mentioned, which of course would be a front end lend sort of steepener. Now, in terms of the dollar, again, I think it's pretty simple that we've seen the dollar rally a little bit over the last few days. We see here it's kind of crawling up. You see these moving averages. It's still pretty weak. Let's just keep this all in perspective here. This is still very much in a downtrend, and we still don't even have the 20-day moving average moving over the 50-day EMA here. I mean, they're almost touching it. It couldn't even do that. Rejected back, a couple of weeks ago at the 100 EMA. So this is still a weak chart, but nonetheless, over the last few days, the euro has weakened. The dollar index, which we see here, has strengthened a little bit. And that's going to be a little bit dependent on where we go with Powell, of course. Pretty simple. If he says, data dependent, still worried about inflation, there's no reason, I think, why the dollar cannot sort of head up a little bit more. But I still think that the dollar structurally, with Fed independence under attack, with fiscal There's a lack of fiscal discipline. There's still plenty of sort of deficit spending, a lot of issuance of the bonds, a lot of, sort of a lack of, as I say, fiscal discipline. For me, it's hard to see the dollar rallying anywhere really, to be honest, above, let's say 99 and a half or certainly 100. I think at that level there, you'd start to be looking to go short. But for sure, in the short term, a slightly hawkish a Powell could get that up a little bit. But again, there has been a bit of a concession built into that. A similar kind of situation for let's say something like gold. Let's just move over to gold. Again, gold, as we can see, has come off a little bit, the stronger US dollar. I mean, gold, though, having said that, this is more of a sideways consolidation. And although it just on the COMEX, on the tariffs and whatnot, it spiked higher. If you look actually at spot gold, maybe we'll look at spot gold rather than the futures. If you look at spot gold here, nothing particularly crazy. It's literally in the middle of a summer range here, right? Basically, this point here about 3,330 where we are right now is right in the middle of all the volume here, in the middle of a consolidating kind of triangle. It hasn't really been a retracement in any sense here. If this is the worst it gets for gold, this is actually very, very bullish. I mean, if it can't go down any more than this. Now, for sure, this has got to be dependent on, again, what Powell says today. A strong dollar might get gold selling off a little bit more. But on the other hand, sort of a slightly dovish sort of Powell, that would imply maybe less fight about inflation and sort of a weaker dollar, and that could push gold up. Now, equities is an interesting one. Let's just go up here a little bit to equities. You see here equities. I think if Powell is, let's say, sort of neutral and signals that he's open to a cut and is data dependent, one could argue that he's not fully focused on inflation. And in that scenario, one could argue that historically with mild inflation, 2.75%, 3%, we're not talking 5, 6, 7, 8% inflation, but let's say an inflation level 2.5, 2.75. 2.8, something like that. One could argue that the stocks, if I can't see the stocks here, sorry, my computer is really just sticky. You could argue that as an inflation hedge, our stocks are quite like would be quite sort of beneficial in that situation, and certainly would be bought against something like bonds. So that could be something which is a positive. On the other hand, if he talks about aggressively, not needing to cut. And fighting inflation, maybe stocks could have a little bit of a pullback here. But the economy is still in a pretty strong situation. And one of the interesting things is that if Powell thought the economy was strong enough to not need sort of cuts, and also if the economy was strong enough to not need to not worry about the employment situation, one could also argue that that's signaling sort of confidence in the US economy and therefore the broader potential of stock market. So I don't know how much of a huge of a move there'll be on stocks today, as we saw from the ES as a sort of options chain there. They're only expecting about a 50-point move. Which, if just to put that in perspective, is something, around about this. So you can see that a 50-point move is actually quite small. It's only, under 1%, about 80 or 90 basis points or so. Okay, guys, I'm going to leave it there. That's really going to be the focus today. That's happening at 10 o'clock. And it is Friday in August. So I think the market will digest that. We can look at other things next week, but let's see how Powell goes. Just a little technical thing. Normally, the actual speech is released at the same time he physically starts speaking. So, we're probably going to start getting headlines at 9:59 or 10 o'clock. There'll be all of the headlines from the speech will come out, and we can enjoy the market reaction. Thanks very much. Hope that was useful. Have a great weekend, and we'll keep this going next week. Thank you.